Hey everybody, it's Eric with Low VA Rates. Today, part 2 of a 4-part series where I'm going to talk about 3 reasons you should consider a VA cash out refinance, even in situations where your interest rate is going to increase. You see, the thing is, a lot of people, they want to refinance in order to lower their interest rate. But what about in a market when rates are starting to go up? In today's video, we're going to cover 3 reasons, as I mentioned, why a cash out refinance could still be a smart idea, even in situations where there is a rate increase. Now, as you probably know, it's Friday. You know this because we all know when it's Friday, but more importantly, I wear red every single Friday in the office or out of the office, traveling or just laying around at home. I wear red, and I'm going to invite you to do the same thing. It is an outward expression of how I and most, if not every single employee here at Low VA Rates, for that matter, feels internally about our military men and women, our veterans. Please wear red and show your support. Speaking of red, if you'd like to click the subscribe link down in the bottom right corner of your device, you can follow along with us every single day of the week when we're putting out what we hope is very, very valuable content for you. I want to get into the very first reason of these 3 as to why you would want to refinance with a cash out even when interest rates go up. And here's why. It's actually cheaper to increase your interest rate slightly in order to pay off higher interest rate debts. Okay? It can be cheaper. When I say cheaper, we're talking less costly, less interest. It can be cheaper with a higher rate when paying off debt. I just want that there so that you can refer to it, assuming you can read my writing as I explain a little bit. Let's just assume you've got these higher interest rate debts. Where would those be? Well, first and foremost, and the absolute highest debt anybody out there can be carrying is a credit card. And we all have them. With an average interest rate right now of around 20% that compounds daily, getting rid of your credit card debt, knocking it out completely if possible with money from a cash out refinance will save you a lot of money. And I'm going to dive into this a little bit deeper in my next video. Remember, this is a 4-part series. This is part number 2, so follow along. But I just want you to think about it this way. If you increased your mortgage, let's say from 3%, that's where you are today, and you went up to a 3.5% mortgage on a cash out in order to get rid of debt, credit card debt that's accruing a 20% interest, that is a smart move, right? 3% is better than 3.5%. I got that. But 3.5% is a heck of a lot better than, let's just say, 20%. And if you're like, oh, Eric, my credit card's not at 20%. If you've got an amazing credit card, you're still at 12, 13, 14%, and it's going up because of the situation our country is in with inflation. So just know it is almost always a no-brainer. Yes, your interest rate is going to go up a little bit, 3% to 3.5%. But when you start consolidating debts under a mortgage, it's a very, very smart move since it instantly increases the cash that you are able to access through pulling out that equity. Better cash flow also means that you won't feel that sting of inflation that many of us are feeling right now. Have you been to the gas pump lately? Imagine if you could save yourself $500, $600, $700, $800 a month in cash going out. That's going to make the current situation that we all find ourselves in easier to manage. Let's get into the second reason. I'm going to try to do that without erasing right now, save some time for those watching today. Second reason, you can always refinance this higher rate back into a lower rate when the time comes, okay? I like to put it this way. Number 2, what goes up always comes down, okay? Now, do I have a crystal ball? I do not. Am I absolutely certain that interest rates are going to come down? I can't be absolutely certain. But we should always make our financial decisions, and mortgage decisions are one of a financial nature based off of history and based off of facts. Now, anyone that's in the financial markets knows that we cannot say because something happened historically, it's certain to happen in the future, but we all base our decisions on that common idea. Historically, when rates have gone up, they start coming back down within a couple to a few years after that. I got into the mortgage world when I had bright red hair, kind of like this shirt. I hadn't gone white, gray, whatever you want to call it. I got going on up here over 20 years ago. In the year 2000, I graduated from college. I got into the mortgage world. Interest rates were at 8.5%. I know this because my parents helped me get a condo. Interest rates started falling, and they continued to fall, and they continued to go up, and then they continued to fall until right now, 2022, 22 years later. And I'm telling you, go to Google right now, type in historical, bar chart or historical graph of mortgage rates, and you will see something like this. Okay, we were way up here in the 8s. We're now down here in the 2s, but look what happened. They'd go down, they'd go up. They'd go down, they'd go up. The trend has been downward. Even if we start an upward trend right now, interest rates are going up, they will start coming back down. Why do I tell you this? Take the higher rate that you have to take right now. Get rid of your debt. Be smart with your money, and then know when the opportunity arises, you can use the VA's Streamline or IRRRL, 3 R's in there, to get quickly back down into a lower interest rate. I don't know when it will happen, but I do know it is bound to happen because what goes up always comes down. Reason number 3, you can get a large chunk of change relatively cheap. Why do I say relatively? Where else can you go out and borrow money right now in the low 3s, 4s, or 5s? The truth is, even if your rate goes up a little bit, rates are still at historic lows. So 3, relative to any other debt you have, relatively cheap. Borrowing money against real estate, against your house, is, in my opinion, one of the smartest places and one of the least expensive places to borrow money because it's secured by real estate. That's why all of the most wealthy and the most financially sound people, probably that you know in your life, utilize mortgages. Relatively speaking, even if your rate goes up, it is still an absolutely good time. So even though rates are rising, rates are still lower than they have been for many, many years. Okay? The pandemic helped push interest rates to an all-time low. So we are going to go up from here, but we are still lower than we have been for, many times in the last 5 or 10 years. That means if you can get a cash out refinance right now, you're still getting a great deal, a very, very good deal. When it comes to rising rates and your mortgage, it's really important to keep the big picture in mind. Don't focus so much on the interest rate. Focus on payment. Focus on cash flow, especially for those of you out there that are carrying high interest credit card debt that should be paid off. I'm going to be diving deeper into how that works in the next video, which will be part 3 of this 4-part series. Thanks for watching today. Go grab a red shirt or something red and put it on if you're not already wearing it. And I hope to see you back here next Friday for another very important topic.